Now, we've talked about how we calculate the value of a bond, and I'm going to go over a common misconception. So, people would ask, why would you buy a bond if interest rates are going up? Because when interest rates go up, according to the time value of money formula, the price of the bond goes down. So, you really would say you only want to buy a bond if interest rates are the same or if they're going down. But we're in an environment where interest rates are going to increase. Uh, Likely for the next decade or so. So why would anyone be buying bonds? And there is, there's an incorrect statement in there. We'll get to that in a second. So let's look at the same bond that we just did, and we calculated that the value of that bond was $986 because it was paying 3,000, or it was paying 3% interest as opposed to 3.5, which was the market rate. So essentially, what it's saying is the market is expecting the interest rate to be 3.5% for the next 3 years, which is why this 3% bond is only trading at $986. Okay, so in other words, that interest rate increase of 0.5% that we're expecting is already built into the price of the bond. So you're not expected to have a decrease in the price of the bond when interest rates go up to 3.5, because that's what's expected. So in this scenario, you could argue that interest rates are increasing. And if you bought the bond today at $986, it wouldn't go down in value because it was fully reflected into that. So what happens? When will it go down? It'll go down if I change this statement that I just wrote out to include when there's an unexpected increase in interest rates. So interest rates increasing will not result in the price of a bond falling. But if interest rates increase by more than expected, that will result in the price of the bond falling. So we're expecting them to go up to 3.5%. So if they go up any higher than that, then the bond price will fall. But if they don't go up by 3.5, then the bond price actually will go up. So let's look at the example. Today's rate is 3%, and if we're looking at if that was the actual expected rate in the future as well, the bond value would be 1,000. It would be at face value. It's paying 3. That's what we're expecting interest rates to be. It'd be 1,000, but that's not the case. The current yield is telling us we're expecting it to be 3.5% in the future. So we're expecting a 0.5% increase in interest rates. And as a result, the bond has priced in a decline because of that increase that's reflected in the yield. And the bond price then falls to $986. So that's the market value today. So the difference, that $14 below face value, is because of the fact that everyone is expecting interest rates to increase. And that's the consensus, is it'll be 3.5. So what if interest rates actually go up to a different number? They increase to 3.75%. Now you're running into a situation where they've increased more than you expected. So then you would expect the bond that you bought today at $986, you would expect it to fall in value. Probably not a lot, but it would fall. And I calculated it using the same formula. It comes to $979. Okay, so not the $986 that we paid today. Let's look at a completely different scenario. What if the interest rates increased, but they didn't increase to 3.5? They only increased to 3.25%. Now we're in a situation where interest rates are increasing by less than expected. So even though they're going up, the bond price actually will go up because they didn't go up by as much as we thought. And in this case, when I run the formula, it comes out to a bond price of $993. So we paid $986 for it today, and it goes up by $7. So you can see here that in all of the scenarios that I've looked at, interest rates have gone up. They went up either 3.5 from our starting point was 3. They went up to either 3.5, 375, or 325, and we had 3 different results. If they went up exactly as we expected, the bond price wouldn't change. It stays at 986. If they increased by more than expected, the bond price would fall to 979. And if the bond price, or if they went up by less than expected, the bond price actually increases to 993.